Breaking news this morning, Fox Business confirming Charles Schwab will acquire Ameritrade for $26 billion. We are waiting on the announcement from Schwab, but this is creating an asset manager with $5 trillion in assets under management. Joining us right now is Andersen Capital Management owner Peter Andersen. And Peter, it is good to have you this morning. What do you think the impact is and your reaction to Schwab acquiring Ameritrade?
Well, I think it's quite a surprise, but the zero commission dynamics that have been happening, Maria, I think will cause this kind of consolidation in the field. You know, I worked with both firms and continue to work with both of them, and I think it's a step up for most investors and clients of TD, because I personally think Schwab has a better service, better research, and all around a better company. So it's a definite plus for TD.
So what about the idea that online commissions are at zero? How does that play into it? I mean, do you think that forced this move, given the fact that Schwab was the first to cut commissions and everybody followed? They've got to continue gathering assets?
Absolutely. You know, I'm starting to think that it's a brilliant move on Schwab's behalf, that it might be actually a strategic action that they took when they zeroed out commissions. That probably was laying the foundation for this kind of transaction. So I think it's very, very smart of them to do that. And I think that smaller companies, smaller brokerages will really be in trouble, because that, as you can remember, you know, 30 or 20 years ago, 10 years ago, commissions were the bread and butter of these companies. So they're really going to have to scramble to find substitute revenue sources, right?
So, I mean, I would agree with you, Peter. It was a brilliant move. And the reason I say that is when I was running UBS, we had $1 billion technology budget. It was going to be $1 billion whether we had $1 trillion under assets or $2 trillion under assets. And so, therefore, you had to figure out how to get that marginal revenue up. One of the best way was you could wait organically, or you could just buy it. And most people in financial services buy it, because I think we go back to your point that if you keep growing and you can find the synergies and take out costs, and actually if we're in an environment where people's wealth continue to creep up, then the assets under management will go up. Who do you think this hurts the most? I know that you were very supportive on this deal, but who do you think it hurts out there, other than the little guy? Any of the big names?
I don't think the big names, but I do think, say, the secondary brokerages will definitely be sweating this out, because who are they going to marry? They will have to have more consolidation. And as you said, you know, the technology of this kind of work, just the relentless demand on new technology and cybersecurity and budgeting for things like that. So if you have a fixed budget for some of these smaller companies, I think they will run into some kind of trouble or pressure on their top line revenues, because it just the profit actually too will suffer, because you'll have more capex. And when you have more capex, as we know, the profits do decrease.
To answer your question, one firm that would suffer would be TD Ameritrade. That's why it basically is selling itself to Charles Schwab. Yeah. That it probably saw the writing on the wall that it was going to have a difficulty competing in this zero commission environment.
Yeah, exactly. We'll see if we have more deals over the near term. Who's left to get acquired? Futures are mixed this morning amid reports of renewed U.S.-China trade talks. Meanwhile, retail earnings trickling out this week. Target still up amid strong earnings yesterday. We're expecting BJ's to report within the hour, and Macy's will come later this morning. Peter, what's your take on the consumer?
Well, Maria, you know, Target is doing also a brilliant move, I would say, because what I love about Target is they're experimental. You know, their online sales were up 31%, but that didn't come very easily. I mean, if you read the details, they've tried several ways of getting the consumer to convert to online sales, you know, curbside delivery, home delivery, things like that, and they keep trying things, and I think they finally got the solution for their business, which is curbside or store-side pickup. Other companies will have to figure out their own way, such as Home Depot. You know, I think they're still in the midst of trying to figure out what's the best way for us to work with consumers. But Target is the gold standard right now of how to work these things out.
Peter, would you buy the market right here with all these record highs that we're seeing every day?
I am buying the market. And, you know, there's a lot of issues about trade and tariffs. And, you know, I'm starting to think there might be an actual tariff derangement syndrome out there at this point, because tariffs, they're very, very hard to model. People are almost becoming hysterical about the daily tweets of whether or not we're reaching an agreement. And when you look at the big picture, you know, I'm actually thinking that it's not going to have that much of an impact as many economists have been modeling, and actually scaring the CEOs more than they are scaring the consumers themselves. We've seen consumers do very, very well so far.
You agree with that, Liz?
Yeah, I mean, I totally agree with you. I think that consumer numbers, spending numbers continue to surprise. The market is so eager to interpret something like a Kohl's misstep as a sign of a weakened consumer. But as you just pointed out, all these department stores are scrambling for a model, for new ideas. Kohl's too, and theirs didn't work, and Target's did. I mean, end of story. But the consumer seems fine.
Yeah. All right. We will keep watching. Peter, it's great to have you this morning. Thanks so much.